Welcome to Hybrid Forex. Hybrid Forex is where we use a particular methodology to trade the foreign exchange market, and it allows us access to high probability trade setups with removing as much emotion from the markets as possible. The term hybrid represents the best of technical and fundamental analysis. Many traders have opposing views on technical and fundamental analysis. Some only use technical analysis and others only use fundamental analysis. Really, it comes down to your state of mind and your style of trading. But with hybrid, we have been able to combine the fundamentals with the technicals to come up with something that I refer to as the 5-pillar approach. For those of you who are new to Forex, please read our risk disclaimer. The 5-pillar approach. It entails 5 tools that we use to identify high probability trade setups. We use long-term fundamentals. We use the trend. We see if it is our friend. Support and resistance. Price action, and the Fibonacci retracement. I'll be exploring these and showing you how to apply them to the charts in further videos. Rules of engagement is what I use to determine how much I'm ready to risk on any one trade. So I'll never risk more than 2% of my total account on any one trade, and I only ever risk the full 2% on any one trade if it satisfies the 5 pillars. So therefore each pillar is worth 1/5 of the maximum 2%. So let's look at an example. You are looking to short the Aussie US and it only satisfies 3 of the 5 pillars, and you have a $10,000 account. Therefore the maximum 2% allowable on any one trade amounts to $200, and 1/5 of $200 is equal to $40. So each pillar that is fully satisfied adds an additional $40 to the trade. In this example, we have satisfied 3 out of 5, which is $120 in total risk. Entry points. The 5-pillar approach serves as a dual purpose. It allows a user to manage risk while identifying entrance points to high probability movements in the market. Support and resistance is a popular tool for entry, but it is not the only tool that we can use to spot entry points. Fibonacci retracement, recent price action, and moving averages can also be useful alternatives to enter the market. I'm probably going to explore moving averages when I introduce them in the following videos, and I'm going to reiterate the importance of moving averages, in particular with trend trading. Stop loss placement. After analyzing a potential trade setup, we must identify at what price our stop loss will be placed. So if price does move against our position, we can be stopped out at a particular price. Each trade setup is unique, therefore our stop loss placement will also be different to that of the last, which means we will not always use support and resistance to place a stop loss. We need to adjust with the markets and adapt. This particular concept will be better explained through a practical example, which will be provided in a following video of analyzing the charts. I'm going to leave you with a philosophy from the ancient Greek Aristotle. We are what we repeatedly do. Excellence, then, is not an act, but a habit. I'm going to leave you to ponder on this and think, if you were to make discipline a habit, would you become a more profitable trader?